Welcome to Academic Gain Tutorials. In this video we will discuss about dividend capture strategy and understand can you really earn easy money. Dividend capture strategy is a short-term investing method where an investor buys a dividend-paying stock before the ex-dividend date and sells it shortly after, hoping to receive the dividend payment. At first, this may sound like an easy way to earn quick income, but in reality, the strategy is not as simple as it looks. First, an investor looks for a stock that has an upcoming dividend. Then, the investor buys the shares before the ex-dividend date. After that, the investor holds the stock through the ex-dividend date to become eligible for the dividend. Once eligible, the investor may sell the shares after the ex-dividend date. To understand this better, imagine a stock with an ex-dividend date of May 15th. The investor must buy the stock before that date, for example on May 10th. Then the record date may be May 16th, and the actual dividend payment may come later, such as May 22nd. So, the important point is that to receive the dividend, the investor must own the stock before the ex-dividend date. Now let's look at a simple example. Suppose an investor buys a stock at $50, and the company announces a $1 dividend per share. After the ex-dividend date, the stock price may fall to around $49 because the dividend value is usually reflected in the share price. So, even though the investor receives $1 as a dividend, the stock price may also drop by about $1. As a result, the dividend is not always free profit. However, this strategy sounds attractive because it gives the idea of quick income, it is easy to understand, and it works around known dividend dates. But there are hidden risks and costs. Stock prices often fall by the dividend amount, taxes can reduce returns, brokerage fees and bid-ask spreads can reduce profit, and market volatility can create losses. Also, because the holding period is short, timing becomes very important. On the positive side, dividend capture may generate dividend income, it is simple to understand, and it can fit active trading strategies. On the negative side, profit is not guaranteed, the share price drop may cancel the dividend benefit, taxes and trading costs may reduce gains, and the strategy requires discipline and accurate timing. So, is dividend capture really easy money? Usually, no. Dividend capture is not guaranteed easy money because stock price movement, taxes, and trading costs can offset or even exceed the dividend received. Therefore, this strategy may be more suitable for experienced traders, especially when transaction costs are low and the tax impact is clearly understood. The key lesson is that dividend capture can look simple, but real profit depends on total return, not just the dividend payment. This video is for educational purposes only and should not be considered financial advice. Always do your own research or consult a qualified financial advisor before making investment decisions. If this short video was helpful, give it a thumbs up and subscribe to the channel. Thank you.